Hello and good morning, good afternoon, good evening, wherever you may be. Welcome to this session on the architecture options for a central bank digital currency. I'm happy to be able to share with you a panel of 4 excellent speakers with a wealth of experience from throughout the world on the subject of central bank digital currency and the architecture, solutions and options for it. My name is Peter Kerstens. I am myself an advisor for technological innovation in finance at the European Commission. That is my day job. And alongside that, I also chair the policy and governance working group of the Digital Currency Global Initiative of the ITU. The Digital Currency Global Initiative is a joint exercise between the ITU and the Stanford Digital Currency, Future of Digital Currency Initiative. And it is composed of 3 work areas or 3 working groups. The first one is on policy and governance, which I chair myself. The second one is on interoperability and use cases, which is chaired by one of our panelists, Julio Faura. And then the third working group of the Digital Currency Initiative is on security and assurance. This panel will focus mostly on the second issue, so on interoperability, technical issues, architecture issues, and not so much on the policy and governance issues, which looks at policy questions such as privacy, inclusion, interoperability from a policy perspective, competition, and so on. The architecture and interoperability and use cases working group has been studying architecture options and solutions for all different kinds of digital currency. So not just central bank digital currency, but also stable coins, e-money, cryptocurrencies, as well as what the operational requirements are and the technical requirements are for issuance, trading, payment, and other technological or technology implementation issues for that. In the session today, so we'll be sharing some of the insights from this architectural working group on digital currency global initiative, as well as the use cases that we've seen in certain central bank digital currency pilots. Now, I think it's time to move to the panelists themselves or introduce the panelists themselves. We have 4 excellent panelists. First, we'll hear from Peerapong Thonnagith, who is Assistant Director and Technical Lead for the Digital Currency Team of the Bank of Thailand. Secondly, we'll hear from Julio Faura, who is the CEO of Adara. And Julio will be speaking about how Wholesale CBDC can help banks manage liquidity and digital assets in a more efficient way. Thirdly, we will have Jonathan Dharmapalan, who is CEO of eCurrency, and who will share with us some insights on architecture of retail central bank digital currency projects from an eCurrency pilot implementation in Jamaica. And fourthly, last but not least, we'll hear from Geoffrey Goodell from the University College in London, who will talk about privacy and custodianship requirements for a central bank digital currency. They will all have their own presentation for about 10 to 12 minutes, and that will then be followed by questions and answers from the audience. So if you have a question, please do, or a comment, please do post it in the chat. With this, I would like to pass it on to Peerapong for his presentation. Peerapong, the floor is yours. Thank you.
Thank you, Peter, and good morning, good afternoon, and good evening to everyone who are visiting in this conference. My name is Peerapong Thonnagith. I'm an assistant director and also a technical team lead on the digital currency team at the Bank of Thailand. Today is an honor for me to share the insight from our past project regarding on the wholesale, and also a glimpse on what will we do about the retail CBDC project in the upcoming years as well. So let me go through the slide. The first one is about the motivation and also the vision for the CBDC as well. What we think as a motivation for the technology, especially on the digital currency, and also the CBDC will address the standing pain point that already exists in the original financial system on that. So I think the best way to do that is to involve ourselves as a central bank alongside with in collaborate with the private sectors in order to explore the possibility in both technical side and also non-technical side on to understand the insight of the technology better, and with the vision in mind that we believe that the CBDC can help to ensure the financial and also the monetary policy and the stability of the financial system, and also it will be the infrastructure for the digital financial system that the private sector can use to build and to innovate to the another level of the financial system as well. So as I mentioned, the best way to understand the implication and also the technical insight on that is to do the experiment by ourselves. It's just like to get our hands dirty on the experiment on that. So back in 2018, we start with the project in Thonnagith, which is the wholesale domestic CBDC. At the first phase of the Thonnagith project, we try to create a prototype which have the same functionality compared to the RTGS system. But we also explore the possibility for the DLT to solve some of the problem, just like the gridlock problem or the liquidity shortage between the transaction between each party as well. So we decide to implement and experiment with the commercial banks to set up a DLT network which incorporate with the privacy function in that network. And also we try to explore the resolution for the gridlock, just like to create an intraday bond to compensate for the resolution of the transaction. From what we have learned is that the DLT have the potential to solve such kind of the problem as well. And by using the capability of the smart contract, it can do some conditional or automatic logic in order to overcome on that. So after that, in the early of the 2019, we extend the experiment on the DLT as well. This time we also explore the possibility to do the bond life cycle, just like if the smart contract can be the solution to help to realize the life cycle of the bond market. It actually have the potential to do that as well. And also with the potential of the smart contract, we try to incorporate with some of the compliance process during all of the transaction, just like to input the compliance check on the sending or the receiving party or something like that as well. To be in short, we try to assess the possibility that smart contract can do within the network. After that, we try not only on the domestic side, but also on the cross-border payment that we initiate in the internal dialogue phase 1 in cooperation with the Hong Kong Monetary Authority. In that experiment, we try to set up some kind of the corridor network that all the institutions, both in Thai and Hong Kong, can hold and exchange with the currency issued by both Thailand and also Hong Kong without the rely on the corresponding bank or something like that as well. This time, right now, the project has been extended to another level with the joining from the People's Bank of China and also the Central Bank of UAE and also the BIS Innovation Hub in Hong Kong as well, which now is the MCBDC bridge that correspond on the cross-border wholesale payment. To summarize in short, after we have done the experiment on the DLT solutions along the way of the wholesale, we see the potential that the DLT have in terms of the resiliency and also the potential or the programmability using the smart contract to do such innovation on that. However, at that time we saw some limitations, especially in the performance and also the scalability regarding the expansion of the network. And also one of the key issue that may be the flaw by design of the DLT is about the privacy. About the term of the privacy, I not mention about the identity privacy, which is pseudonymized by the wallet address, but also the transaction privacy, which is any time that there is a transaction that involve a large volume of money on that, and it has to be seen by the third party, which is the basic fundamental of the conventional DLT. It has some matters with the concern for the involving party who do that transaction as well. After that, not only on the technical side, and also the implication on the business side, just like on the cross-border project. The first one is that for the seamless transaction on the cross-border, that means 24/7 system should be up and running, which is quite concerned about the time difference with the operation time of the domestic system, and also the involvement of the freely exchange the different currencies will also make the complexity on the FX regulation as well. Aside from the wholesale track, we also try to explore on the retail CBDC as well. But at first, we does not directly involve the individual retail. So we try to do in the corporate level, just like we try to facilitate the infrastructure of the CBDC to some of the companies, just like the merchants and also some of the supplier company on that. This time as well, we explore on another type of the blockchain. It's a modification on the Ethereum, which is different from the wholesale project that we use the enterprise DLT. So that we try to design the model to be the two tiers, that we try to keep the role of the intermediary, just like the bank and also financial institution, to do the distribution of the CBDC. And also for the retail, which is a corporate one, they can do the payment between each other, and also to apply some conditional, just like to issue something like an invoice token within the network, and also to redeem with the predefined money automatically with the work of the smart contract as well. The insight that we have found from the corporate retail CBDC is that the resiliency and also the potential on the programmability can be achieved the same as the wholesale project. However, in the issue of the scale and the performance, it may become worse than the wholesale experiment, since it involves more party and also more customer in the process as well. And also the transaction privacy still be an issue on that. In the experiment, we have tried some of the privacy mechanism that will operate on top of the network, just like the zero knowledge proof. But by implementing that, we can achieve the privacy, but also sacrifice the performance, which is bad at first and to be worse when we apply the privacy on that as well. That is all of the past work we have done so far. So on the following years, we are trying to do on two tracks. The first one is the extension of the internal dialog to to become the MCBDC bridge right now, with the involvement from another two central banks into the network. Now the complexity have been escalated from some of the experiment that can be done between two authorities. It may not apply to when more of the parties or more of the authority joining on the network. So we try to revise some of the technical and also some of the mechanism to achieve the expectation on the cross-border payment and also the exchange between the currency as well. And not only that, we try to assess on the implication on the legal issue, just like the FX regulation, which is different between the countries or something like that as well. That's the one with the one project on the cross-border side. The other one is that we try to accumulate the insight from the corporate retail that I mentioned earlier, and then we try to formalize the concept and also the key detail on the individual retail CBDC on that as well. We have announced our direction paper since earlier in the last year, and what we will do next is that we have done some of the experiments on the technical solutions for the retail CBDC, and if the plan goes smoothly, we hope that we can do some of the small scale pilot tests, which will involve the real use of the retail CBDC in some of the limited controlled environment within this year. That's our plan for now. To touch on some of the design or for the retail CBDC that we have already announced in the direction paper as well. The opportunity is that to be a digital form of the central bank money that is safe, reliable, and accessible, and also to be an infrastructure that support both the inclusion and also the innovation. That's why some of the key criteria that we use is that we still stick to the two-tier models, since we would not face for the disintermediation issue, and also since we do not to replace the role of the commercial banks, so the CBDC will be non-interest bearing, and also to have zero to minimal transaction fee in order to encourage the innovation on that. The key point is that based on our experience on the DLT, we saw the issue on the performance and also the privacy. At the current experiment, we try to do to assess the solution which is not on the DLT platform, but ultimately we would like to seek out for a protocol or mechanism that will be neutral to the underlying infrastructure, and whether it is a DLT or non-DLT on that, so it can be adopted regardless of the underlying on that as well. That's all for my presentation, and you can seek out for our past result based on the QR code that I have just shown on the slide, and also when the slide can be public later. Thank you. That's all for me. Thank you.
Thank you very much, Peerapong, for that presentation. Maybe we can move straight ahead to Julio with his presentation, setting out his views and perspectives. Thank you.
Thank you, guys. No, I just need some space here. So, hi everybody. Yeah, we're going to be talking a little bit about wholesale CBDCs. We think that wholesale CBDCs are probably more advanced and more closer actually to make it to production settings. And we're really observing that in the industry today. I think part of the reason is the true benefits that this can bring in a very practical manner to financial institutions, right? Particularly in the case of wholesale CBDCs, as I'm saying, instead of retail, right? I mean, retail CBDCs can be something really transformational, obviously, but the implications in terms of monetary policies and I mean, the implications can be really staggering, right? So that's why I think wholesale CBDCs are simpler probably to surface these potential benefits to financial institutions. I think the main benefit this can bring is helping banks reduce the amount of liquidity that they have to use in order to conduct their operations, right? Their wholesale banking operations, and particularly the problem there is today when it comes to liquidity with credit counterparty risk. I'm going to share a couple of slides to illustrate some of the concepts that I'm talking about. Today, the situation in banks, in banking groups, is that commercial banks will have different pockets of liquidity that they use to conduct their operations, for example, in payments, right? And essentially, most of those liquidity pockets are based on other banks, right? There are foster accounts in correspondent banking models, right? I mean, I know banks, tier 2 banks, tier 1 banks are even bigger, but tier 2 banks will have easily thousands of foster accounts, hundreds if not thousands of foster accounts, and that's really a lot of liquidity in the system, right? They have to carry a lot of excess liquidity to perform their operations, which is very costly. Oliver Wyman estimates that there's about from $100 to $300 million in financial cost every year for the excess liquidity that is needed, right, in order to conduct normal operations, including payments, but also settlement of other things like derivatives or capital markets and so on. Right? So this is one of the main one potential area of application. I say one potential issue. What issue that exists today in wholesale banks, right? Also, the thing is that all these liquidity pools do not really work in real time because they are foster accounts that are hosted by banks through all these correspondent banking relationships. And it's difficult for these banks to even know how much money they have, you see, because they are not really used to working with real-time assets. These things do not really work in real time. They have to reconcile these exposures maybe once throughout the day or even with less periodicity than that, right? The other problem is that the applications that the business processes that actually need settlement are not digital. Take, for example, the example of payments, right? There are other examples, but cross-border payments, particularly, and cross-currency payments are a very good example. Payments do not exist really as single digital objects, right? They are multilateral processes that are based on messages, right? So it's difficult to understand what is the status of a payment at a given time, right? And all these messages, or all these agreements between banks when they process payments on behalf of clients do have their effects in terms of settlement, right? They will need liquidity to settle, but the communication between those two things is not well coupled, right? And that leads to needs for reconciliation in all these processes to determine what are the amounts that need to be settled later on all these liquidity pools. And that is costly, it's error prone, and again, it doesn't work in real time. Now, wholesale CBDCs, we believe that can be a good solution for this, right? First, because they actually work in real time. And but most importantly, because wholesale CBDCs do not have credit counterparty risk, right? Because they are central bank issued money, or they are central bank backed settlement assets. Right. So if banks could have access to a wholesale CBDC construct, that would be very beneficial, because first of all, they could avoid all this fragmentation of liquidity they have today. And these new liquidity pools based on central bank money would be, would have no credit counterparty risk, right? And therefore, this could be very useful to, first of all, reduce the amount of liquidity that they need to perform their operations. And second, it would be useful to reduce the credit counterparty risk, and therefore the capital consumption that is associated to these deposits, right? And that can translate into hundreds of billions of dollars per bank per year in terms of financial costs, right? Optimization. If we take a look at how we are seeing these things to play, and this is really what I wanted to talk about. Really, the emergence of CBDCs is something that we're now seeing in the market. I think Finality is the perfect example. It's not exactly a CBDC in the sense that it's not money issued by a central bank, right? That is true, but it's a settlement asset that is backed by an omnibus account at a central bank, and therefore it does not have credit counterparty risk and can be used for settlement purposes. Now, the beauty of things like Finality, wholesale CBDCs that will be issued at some point, even other types of CBDCs, even retail CBDCs that could be used for wholesale purposes, although I think the most realistic scenario is to have a specific CBDCs for wholesale use before trying to mix central bank money for retail uses, right? That, again, there's a lot of research in the market, and then we'll see how that plays out. But anyway, all these assets, right? All these settlement assets, and you can add others like commercial bank coins. So kind of the same assets, but backed by or issued by commercial banks or decentralized ledgers and that sort of thing. All of these actually work in real time. And treasuries, banks, they are starting to think about these assets just as if they were other assets, right? And not in many cases they're really understanding that this can really change the way in which treasuries work, right? If you are a treasurer in a bank, you essentially have to, you work on a daily forecast basis. You essentially have to do a forecast the day before. You have to understand how much money you have in your settlement pools, right? All these accounts we were talking about before, or RTGS accounts that you have in different central banks or whatever it is. And you have to see what are the needs for that liquidity. So where are the payments, the volumes from the payments, how much money are you going to have to settle with other counterparties in the market, coming from payments, coming from collateral management, from pledging, from capital markets and derivatives and effects, I don't know, all your different commitments. You have to do a forecast, right? Then you typically have to pre-fund your amounts in your liquidity pools. You have to put together all that liquidity. So all these different business processes will find the liquidity there when the settlement time comes, right? And that's what the excess liquidity that is needed on a daily basis comes from, right? Then you go throughout the day, and then at the end of the day, you reconcile and make sure that everything went well, and you start for the next day, right? That's what creates the excess liquidity that you need in order to conduct your treasury operations. And that's a source of inefficiency. Now, if you have digital assets, now these things work in real time. And because they are digital, you can couple them with the payment processes and the capital markets processes, right? And you can also build funding marketplaces. So places where you can actually come and fund your liquidity pools, either through tokenization or through credits, through loans, through deliverable liquidity swaps, whatever it is. So imagine a treasurer now that can actually, instead of going through all these forecast and daily forecast and reconciliation cycle, they could do a just-in-time funding philosophy, right? So essentially, they would be able to fund whatever they need, when they need it, where they need it, for the purposes they need it, in a much more agile fashion. And because of that, we'll be able to use much smaller amounts of liquidity without having to pre-fund everything at the beginning of the day. So that's what I think the digital assets provide, right? First of all, banks are able to see how much money they have. They are able to see how much money is needed in every time, because at every time, because they have access directly through all these, all these digital marketplaces that are very well coupled with all these settlement assets, including wholesale CBDCs. So that enables this just-in-time funding philosophy that can, it does need to, for these banks to change the operating model in which they operate in their treasuries, but the benefits can be really significant, right? Because this can reduce a lot the amount of liquidity that is needed. So that's what I wanted to share, how digital assets can actually enable this new target operating models that treasuries believe is a quite transformational opportunity for the financial industry. Thank you.
Well, thank you very much, Julio, for this presentation on how a central bank digital currency could operate in, I would say, the wholesale cash management side of a bank's business, which is to many people a very exotic area, but it is crucial for the operation of the financial sector. With that, we'll now move on to Jonathan Dharmapalan, who will share his experience from his work at eCurrency, and I understand in particular applied to the projects they've run with some central banks, in particular Jamaica. Jonathan, the floor is yours.
Thank you, Peter, and thanks everyone for joining us today. I'm going to talk specifically about the role of trust in the architecture for a central bank, the architecture of a central bank digital currency. And the reason I'm going to address this from the perspective of the role of trust is because the fundamental architecture that would be put into place for a central bank digital currency, or frankly, any currency, starts with some presumptions around whether or not we are building for a trust-based environment, or if we are building for a trustless environment. Now, much has been discussed around the trustless environment, and for the most part, most cryptocurrencies operate in a trustless environment, thereby applying principles of blockchain and distributed ledger. I'm going to talk about a trust-based environment, primarily because for a central bank digital currency to exist, the trust has to be placed in a central bank to issue that digital currency. That leads to certain decisions that essentially start at the central bank level. The authority to issue that currency is granted upon the central bank by the government or the nation, and the central bank then takes upon itself the responsibility to issue a known amount of currency, which is how it works in the physical currency world and should continue to work in the digital currency world. And the known amount of currency essentially becomes the M0 of the country. Now, what does it mean for something to become the M0 of a country? Well, it means that the boundaries of that currency are known, the amount put into circulation are known, and at least at a theoretical level, the central bank can be assured that no more, and actually no less than what they put into circulation is in circulation. In the world of a digital currency, that becomes an interesting problem to solve. And the problem we're really solving is a set of boundary conditions somehow secured through cryptography, that a central bank can know how much volume they have created in currency, and then subsequently put it into circulation, such that the wider public, in the case of a retail CBDC, or a limited number of participants in the case of a wholesale CBDC, can exchange it on a day-to-day, person-to-person, person-to-bank, bank-to-bank basis. For that, many central banks have actually started thinking about a two-tier architecture. Now, the two-tier architecture really comes from the perspective that a central bank is the minter and the issuer of the currency. And they will then use the private sector, primarily starting with commercial banks, but not limited to commercial banks, to get that currency distributed into the hands of the public. Now, this can be addressed by either maintaining a massive central database at the central bank, and that will be considered a highly centralized environment. It could be successfully enabled by maintaining multiple databases at the multiple distributors, or it can be attained by essentially creating a digital bearer instrument that the central bank creates that no one else can modify except under the authority of the central bank, and puts it into circulation. What we have come to discover in our projects, and we have been able to implement, is essentially the creation of a digital bearer instrument. A digital bearer instrument that exists in an environment of trust. The trust begins at the central bank. The central bank creates a known amount of digital bearer instrument or instruments, puts that into circulation in a manner that supports the two-tier architecture, which they currently enable through commercial banks. And if we are able to enforce the security of the digital bearer instrument beyond the commercial bank into the hands of the fintech, various fintech players, and ultimately into the hands of the public. In the hands of the public, the digital bearer instrument could be either held by a proxy on their behalf in a digital wallet, or technically can be held on their person in a complete offline environment, very much like cash. The key in enabling this is to decouple the bearer instrument from the holder and to decouple the bearer instrument from the wallet that it resides in. By decoupling these components, you're able to create a digital bearer instrument that can preserve the privacy of the public while still enforcing the security that the central bank created to make sure that this bearer instrument is non-counterfeitable. In our projects, we have actually been successfully able to deliver this, to enable a central bank to mint a digital bearer instrument, to limit the quantity of the digital bearer instrument to a known N0, put it into circulation through multiple commercial parties, including commercial banks and other financial service providers, and get it in the hands of the public through wallets initially hosted by the commercial parties, but ultimately in an offline environment held in the hands of the public. Now, central banks and other regulatory authorities do concern themselves with regimes such as KYC, AML, CFT. All of this can essentially be enforced at the level of the commercial players, just like they're enforced today in our banking sector. So, to keep this presentation short, I'd like to point out that the initial start of the architecture for a digital bearer instrument is an architecture of trust. The trust emanates from the central bank. The central bank creates the instrument, puts it into circulation through existing infrastructure, which includes commercial banks and financial service providers, and ultimately gets it into the hands of the public by way of a two-tier architecture that has been mentioned before. Peter, that's my initial introduction. I will hold off further comments for your questions.
Okay, well, thank you very much, Jonathan, for that presentation and that perspective on how in a trust-based environment, a model and where the trust is provided by a central bank a digital currency model could operate. Before we go into questions, I'd like to first move to our final speaker, so Geoffrey Goodell, and then we'll go into questions and answers. Thank you. So Geoffrey, please.
Hello. Can you hear me?
Absolutely, we can.
Excellent. Thank you, Peter. So today I'm going to talk briefly about some of the requirements for privacy and ownership for central bank digital currencies. I think with a nod to Jonathan, I think that much of what he described in his presentation is entirely compatible with what we're doing here in the UK, and hopefully we'll be able to describe this in a way that that captures some of the architectural nuances. Certainly, there are implications of privacy and ownership requirements on the system architecture, as Jonathan mentioned, and certainly this will be very interesting to providers of e-money services and wallet technologies and so on. Next slide, please. So the project that we have here in the UK is the FIRE project, which is a future infrastructure for retail remittances. So this is a collaboration between UCL and the University of Edinburgh, along with our industry partners NTT Data, BSI, and Petrus, which is the National Center for Excellence for IoT system cybersecurity. Now, cash is, as it turns out, a de facto disappearing payment option for the public, and that's a concern. And we've decided to focus our project upon understanding how we can deliver a cash-like payment mechanism to the public in the digital world. In other words, cash for the digital age. Now, we understand that cash is very useful, and it's very special in that it's accessible, it doesn't discriminate, it's private, and people can truly own it. And this actually has a legal distinction associated with it as well, which is that cash is a chose in possession and not simply a chose in action, whereas bank deposits are something different, and we'll talk about that soon. But nonetheless, there is a concern with digital transformation that because cash infrastructure carries high fixed costs, and we know what those costs are, the costs of real estate for operating ATM infrastructure, the cost of tills for merchants, the cashing up costs of employee time and transportation to get to banks to deposit and withdraw cash. And all of this is potentially problematic not only for consumers but also for vendors, and as a result, many consumers are increasingly using digital payments to conduct many of their everyday transactions, and this is happening in many countries of the world. So the question that we ask is, how can we create a cashless payment infrastructure that can work for everyone? Now, we're not suggesting that that central bank digital currency would replace cash, but we're acknowledging that in a low cash environment, this is the sort of thing that we might need to do or need to build in order to deliver the affordances of cash in the digital world. Next slide, please. So if we compare cash to modern retail banking with electronic accounts, we see that there are some really important distinctions. Now, cash is actually transacted between parties via a direct and private interaction. The money is actually held directly by the owners. That's the chose in possession that I mentioned. The tokens that are entirely fungible provide assurance that transactions will succeed. You know that the cash that you have will be accepted by the next person that might take it from you. And you also know, because it's fungible, that everyone's money is worth the same as everyone else's, and you also potentially have the option to transact in different currencies. With modern retail banking, all of these things are a bit different. First of all, because the money is actually held by financial institutions, it's not actually owned by you directly. In fact, it's actually owned by the financial institutions, and consumers only have a legal claim on the financial institution's balance sheet, and that's different. The currency is held by institutions. The interaction for payments is done between institutions. And of course, for this reason, we know that transactions might be intermediated or blocked. The users, of course, might be subject to profiling, which is to say that the financial intermediaries collect substantial data that can be used to construct a history of the user, including their habits and circumstances, and not to mention location and associations. And of course, the choice to transact is limited by regulations, and the users could be subject to discrimination. Next slide, please. So, in studying this problem carefully, we've come up with some guidelines, and I think that these guidelines are potentially quite similar to what Jonathan had described, actually. And in particular, this decoupling that Jonathan described is essential to our system as well. It must be possible to store tokens in non-custodial wallets. That's not to say that custodial wallets couldn't exist. It's just to say that non-custodial wallets are necessary in order to decouple the users of the digital currency from the identity-based verification that would be needed to link the users to accounts for account-based transfers. Non-custodial wallets also must not be identifiable themselves, and that, by extension, means that they must not be issued by a central authority, like a key escrow system, for example, or a central issuance, like, for example, the wallet proposal for the eIDAS regulation in the EU. Such wallets must not require registration in order to work, because, of course, this would link the user's identity, and it would link the transactions to each other in the wallet. And such wallets also must not rely upon trusted computing to work, which means that we can't have the secure elements or the secure chips of mobile phones or that kind of model, because that would ultimately mean putting a trusted third party and the requirement to trust a trusted third party into the pocket of ordinary everyday users. And of course, this creates a problem. Trust is something that must be earned and cannot be forced onto the general public. Next slide, please. And the system must be private by design for consumers. And as Jonathan mentioned, the risk of profiling is not actually about knowing who the users of money are. It's absolutely okay to have AML KYC for recipients of CBDC or for account holders with commercial banks and so on. And it's also okay to disallow peer-to-peer transactions as well, potentially. We can build an architecture that requires one party to every transaction to be connected to a regulated financial intermediary, and that would be fine. But the risk of profiling is about knowing how consumers spend their money. And what that means is that the identity of the sender must not be linked to the transaction. And that also means that transactions by the same sender must not be linked to each other. And by the way, there are various different data that could link the identity of a sender to a transaction, including the recipient, the size, the metadata. We need to break the link, and this is done via a non-custodial wallet. And we can use privacy-enhancing technologies to mitigate those risks. Now, zero-knowledge proofs, as Peerapong mentioned, could work for this purpose, indeed, but they are potentially heavyweight and could impact the system performance. We suggest that blind signatures, such as what's been proposed by David Chaum over the past 40 years, and still are proposed by David Chaum, even as recently as last year, are sufficient. Next slide, please. Now, third, we also would like to suggest that the system should be run by the private sector. Now, that's not to say that this is an architectural requirement exactly, but sometimes people make the argument that everyone trusts the central bank to handle monetary policy, so why wouldn't they trust a central bank or a central operator to handle all of their transactions as well? And of course, this makes a number of assumptions that we think are potentially dangerous. First of all, the idea that if you trust an entity in one context, then you must trust it in all contexts, which is not true. And more to the point about privacy, if you store data that could be used to construct a history of a person's transaction somewhere, then the data could potentially be captured by parties that are not wanted for this purpose, such as the ones that I've listed: platform operators, law enforcement, intelligence agencies, criminals, and so on. And finally, that the liabilities and risks for overseeing a system are the same as for operating one, and they're not. So we can actually imagine using a co-regulatory environment to actually have the system be operated by private sector actors and overseen by public sector actors, including the central bank. And that kind of system using a process of distribution is what we propose. Next slide, please. So we recommend having a non-custodial wallet and a public permissioned distributed ledger system for the purpose of forcing the private sector actors in the system to not equivocate in their commitments. And basically, this means that they need to guarantee that as the tokens circulate within the system, that they're not going to be double spent. And this, if we use the distributed ledger not to process transactions, but to process the commitments of these regulated actors, we can achieve. We argue that we can achieve this level of assurance that these transactions will succeed in a manner that is expected. Next slide, please. And how the system works is like this. We imagine that there's a consumer non-custodial wallet, and when the consumer wants to receive CBDC, the consumer will send some kind of payment, which could be either previously spent CBDC or cash or a bank deposit, through to the central issuer, which could be the central bank or its delegates. And the central bank or its delegates would respond with a blind signature on a credential, on a template credential that could be used by the user to create new digital currency assets that can be spent only once. Then when the user wants to spend the asset, it provides transfer instructions to a merchant and then successively to a relay system which can deliver via a commitment a proof of provenance of the asset to prove to the merchant that the asset has been transferred successfully. And then once the merchant receives the proof of provenance, then it knows that the transaction has succeeded up to the level of assurance provided by the relay system, and then the consumer can receive its goods or services. Next slide, please. Now, this relies upon certain assumptions. One is that there's a large enough anonymity set, and that means that the money needs to be held by consumers for some period of time to avoid timing attacks. But once we've done this, we know that we've got a system that actually achieves many of the benefits of cash, and it looks like cash because cash infrastructure is a complex system with a delicate balance of power among its participants. And preserving this balance of power and control means preserving its characteristics. And here, very much like cash, we have a government-issued electronic token that can hold value outside of accounts and can exchange value without account reconciliation. And yes, it does preserve the existing two-tiered architecture that's familiar to the cash system. And importantly, it protects users from profiling through privacy by design. All of the withdrawals and deposits are analogous to cash. Regulators know when someone withdraws money. Regulators know when someone deposits money. However, although regulators know one party to every transaction, they don't know both. They usually can identify the recipient of the transaction in our architecture proposal, but they do not know the sender because the sender is anonymous and is spending an unblinded token that has never been seen before. That is necessary to achieve the degree of fungibility that we have de facto with cash today, and it's an important affordance for ordinary consumers. Next slide, please. Here's some future reading. We've been publishing on this topic for the last 4 years, and we would welcome your questions and your commentary on this. We hope that this is an interesting architecture. It's certainly I think something that we need to bring to the table in the conversation about what CBDC is for. And ultimately, we believe that CBDC is for preserving cash-like affordances to ordinary consumers in the digital age. Thank you.
Well, thank you very much, Geoff, for this. And I think the 4 presentations we've had so far give a very good mix with Peerapong starting with a whole system design, and then Julio going into a specific application at the wholesale level for cash management. Jonathan speaking about the digital bearer instrument as the thing or the instrument in the hands of the users, and then Jeff talking about the wallets in which these instruments are carried and conditions for those wallets. And I'd like to start a conversation where Jeff left off, namely on these non-custodial digital wallets, and the fact that if you listen to debates on digital currency and central bank digital currency, there always is an element of a wallet involved. And my question basically to all of you is, if we're going to see a proliferation of these digital wallets, how are they going to operate together? Is there a need for a global standard for these wallets? And what are the technical standards that these wallets may need to respect? And I put this question to all four of you. Who wants to go first?
Peter, shall I start?
Go ahead.
Okay. So in the architecture that we have considered, the simple answer to your question is no, these wallets do not adhere to a specific standard. In fact, if we are going to promote the necessary innovation that will come with digital currency, we have to allow the wallets to be what they will be. The way we look at these wallets are as merely digital receptacles, and these digital receptacles can reside in a database as we think about today, or the digital receptacle can reside in a completely offline, secure environment that's still to be invented. However, the standardization that we should be thinking about is that the currency itself is standardized. The language of the currency, the cryptography that protects the currency does get standardized, and this is where the central bank comes in. For full interoperability, the wallets do not need to be standardized, but for full interoperability, the currency instrument needs to be standardized so that a dollar is a dollar is a dollar, a rupee is a rupee, and so on and so forth. And they have to be recognizable as standard instruments that originated at the central bank.
Great, thank you. I see, Geoffrey, you're nodding.
Yeah, I wanted to say I agree with Jonathan, although I'd like to add that I think we will also need standards for point-of-sale devices, since they will need to interoperate with these digital wallets that people carry with them. In particular, if we imagine that people will be interacting in using these offline tools, which I would totally imagine that they would, they will need to be able to interface their devices with the devices of the merchants with which they interact somehow. And the protocols for doing that would need to be standardized in some way. That said, do we need one single global standard for this? Not necessarily. It doesn't need to be the same across countries, and it doesn't necessarily need to even be the same across all of the providers of these kinds of services within a country. I think Jonathan is right about that. But I do think that we will benefit from a measure of standardization around these protocols for communicating between these devices, and between consumer devices and point-of-sale devices, and also between consumer devices and financial payments intermediaries from which they receive central bank digital currency.
Very well. Thank you. I don't know, Julio, do you have?
Yeah, from my point of view, I think, I mean, I agree with the others. I think trying to standardize everything is going to be a mess. Actually, it's going to be impossible. But I do think, at least at a technical level, there are some fundamental things that would be nice to standardize so these systems can be built in a more universal way. And I'm referring to this, the very basic functionality of the currencies, as well as the kind of the interfaces, right? Very simply, what can you do with a currency, right? Because a payment system, POS, or more complex things like, settlement in capital markets, just to name a few. Essentially, the way in which they need to interact with digital currencies, they only need a couple of things. And the couple of things are, first of all, it needs to be possible to actually transfer the currency from one account to another. And second, which in my experience and based on the cases I've talked about, is very important, is the ability to do an encumbrance, right? Or a pledging, right? So essentially putting the currency on hold for a payment for a transaction that needs to complete, the other leg needs to complete, and then try to, atomize both legs. So if we are able at least to standardize just these two things, like how do you transfer a currency? What are the fields you need in the API call? We don't need to get technical as to, the syntax and blah, 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 but at least, you need an account, another account, the amount. Do you need anything else, right? And for the holds as well, right? The ability to put something on hold for a benefit, for a notary to then release the money or cancel the hold. I think that would be very beneficial, because with that, then we can build all kinds of systems and they can be interoperable across different currencies. That's my
On a practical level, just to add to those two comments, because I think it's important. So, Julio, what you just pointed out about standardizing the interface, absolutely agree with you. In fact, to kickstart that conversation, we actually contributed an API to the ITU. You can find it on the ITU website to see what a standard API might look like. It doesn't have to be that, but a standard API might look like to enable the interaction between wallet systems and or offline handheld devices to the currency itself. To Jeff, your point, I'd like to differentiate between interconnectivity and interoperability. The ideal scenario is that the interconnectivity, whether that be between a handheld device and a POS, or two POSs, or two wallets, would be ideally something we already know. Wi-Fi, Bluetooth, or still to be created interconnectivity. It's the interoperability that becomes a little bit more involved, and by the central bank setting the interoperability standard, we should be able to achieve this full interconnectivity, interoperability that we'd like to achieve.
Okay, well, thank you. Maybe you can move on a little bit from this subject, but also bring it back to the broader subject. And going to Peerapong, you explained the project which covered in Thailand, which covered both wholesale and retail, but and also the use of the technologies to layer distributed ledger. And I also see some questions in the Q&A where people asking, well, does a central bank digital currency have to use blockchain technology? So can you speak a little bit about what are the differences to be considered between if you're going for a wholesale solution or a retail solution? Is a wholesale central bank digital currency technically different from a retail one? And does the distinction whether you use wholesale or retail, does that depend on, rely on the use of distributed ledger technology or not?
Yeah, the main difference about the wholesale and the retail one is about the impact on what we are involved on that. On the wholesale, we have some kind of a limit users, just like the financial institution. So some of the compensate or the resolution on that is quite limited compared to the service of the retail CBDC, which involve on the public. The first one is about the performance as well. As for the design that the central bank may have the responsibility to determine the finality of the transaction, may not directly on the transaction, just like Geoffrey said, but the validity of the bearer instrument or something like that. That means the performance would reach to support for the whole transaction, not only within one commercial bank, but also from the interbank as well. The other one is about the impact on the privacy for the usage of the of the public as well as the ability to have some kind of non-custodial wallet or something like that. Nevertheless, for my personal opinion, for the wholesale one, the DLT may have more benefit since it may involve on the trust between the entities, especially on the cross-border one, which have more financial authority between the country as well. However, for the retail side, it may depends on some of the crucial criteria that may decide whether it should be the DLT or not. I have an example of 3 crucial questions on that. The first one is that is in your scheme of the retail CBDC, are you allow the existence of other unit or other asset aside from the CBDC within the network? Just like you have the ability to create another unit and to interchange with the CBDC itself within the same network or not. If that is yes, then the DLT have more potential to develop on that based on the ability of the smart contract compared to the centralized one. Another question is about the privacy. Just like I mentioned in my presentation, if the privacy about the content of the transaction matters for the involving party, then the DLT is in the disadvantage side, since the transparency of the transaction is the core principle of the DLT. So if the privacy matters, it will be on the opposite. The last one is about the offline capability. I have seen someone ask for us about the offline payment on that as well. Do you consider the offline to be the priority criteria on the retail CBDC? If the answer is yes, then from my personal opinion, the centralized one have more advantage, but not the absolute advantage in order to implement the mechanism for the offline payment. That's what I think for now.
Okay, well, thank you very much. And moving to Julio, you already mentioned the enormous potential to save on liquidity and to reduce counterparty credit risk in wholesale payments. But could you speak a little bit about how big that opportunity is? Sort of what kind of money are we talking about? Also bearing in mind that, of course, banks currently already have access to central bank money in digital form. So what is the difference between the current access banks have to central banks and central bank balance sheets and this central bank digital currency in the interbank payment system?
Yeah, so in terms of the potential, we briefly touched on that. The excess liquidity, the potential for intraday liquidity optimization, I think the consensus is that that's in the order of, a few hundreds of millions of dollars for banks, let's say, for tier 2 banks, right? Let's say $500 billion to $1 trillion balance sheet, right? Something like that. So, can be hundreds of those banks. So we're literally talking about many billions in potential savings. Not that the whole of that excess liquidity is going to disappear with this, but you can tackle like half of that or 3/4 of that, then the number can be actually quite significant. There's also a lot of potential in terms of operational cost and operational risk that comes from reconciliations, right? From all the communication between the business processes with the settlement, right? I think that's an important one as well. And yes, what you're saying in terms of access to RTGS, yes, they do have access to RTGS, but it's not easy to actually couple the settlement systems provided by RTGS with these other business applications, right? Precisely the nature of programmable assets is to, the ability to facilitate that, right? In the case, for example, of finality, which is a settlement asset that is backed by it's really a claim against money that is held on a non-interest account at a central bank. There is also the possibility for indirect participants to work. So essentially, international institutions that are not regulated under the central bank to have access to that type of liquidity, right? If you read, for example, the benefits that were anticipated by the Bank of England when they published the omnibus account policy, it was the ability to extend the operations or the ability to use settlement assets beyond normal operation hours, right? And also the ability for other type of or international participants to access the settlement assets. So imagine a bank in other jurisdictions that are able to to come and use that type of liquidity, right? So that can give access to other participants, to smaller participants, and provide the benefits all over all over the board.
Great, thank you very much. Then quickly going to John before we can jump to Geoffrey and then wrap up. Is Johnson, you spoke about this digital bearer instrument. That's the essence of the implementation. And you said, well, it can be managed in a central database, but in the trust-based environment, that's not necessary. But the question really is, how would this digital bearer instrument be transferred and managed? And does this require distributed ledger technology, or is a digital bearer instrument and a distributed ledger technology, are they two completely different technologies?
Thanks, Peter. Actually, what we found is that distributed ledger in its own self is insufficient to create and to manage a bearer instrument. We sort of have to take it one layer further. And I think I saw this in the questions in the chat as well. Distributed ledger technology has certain drawbacks at the security layer associated with asymmetric keys that have to be exchanged. And asymmetric keys tend to be prone to quantum computing attacks, and we are quite concerned about that. So essentially what we've had to do is to look beyond the cryptography of distributed ledger to something that we call digital symmetric core currency cryptography. And this is to enable symmetric keys controlled by the central bank, generated and controlled by the central bank, to protect the core of the currency. If you're able to do that, you do not need a distributed ledger network to distribute this currency or to effectuate its use. That does not exclude distributed ledger networks or blockchain networks. It can just as well be incorporated into individual or discrete blockchain networks. But the blockchain networks are not necessary and may not be sufficient to protect the currency instrument itself, because you have to somehow protect that central bank core. And we think the best available technology right now is symmetric keys, and managing the length of the keys and key rollovers and those kinds of security practices. So, long answer to a short question. The answer is no. Distributed ledger is probably insufficient for a true central bank digital bearer instrument.
Okay, thank you very much. And then very quickly, for 1 minute to Geoffrey, because then I'll wrap up in another 1 minute and we'll close in time, is that, and we also got this question, Geoffrey, you talked about non-custodial wallets and that they're necessary, but could you explain once again, what is a non-custodial wallet and why does the wallet have to be non-custodial?
Yeah. So briefly, I actually just briefly, if you don't mind, I'd like to respond very quickly to what Jonathan just said. Also, yes, I'd like to agree that that we don't need distributed ledgers in order to achieve, in order to actually provide the integrity of the integrity of the asset. However, distributed ledgers will be useful and perhaps necessary to avoid the single point of failure or a single point of control by a central operator. So I think that there are different functions here that give rise to different uses of of technologies for different purposes. And do we need a distributed ledger system to do the transactions? Not necessarily, but do we need the distributed ledger to enforce that the decentralized network of parties that do manage transactions are not going to misbehave? Well, yes, we well might, and whether we choose to implement that is, of course, up to the central bank in question. Now the question on the non-custodial wallet. So yeah, a non-custodial wallet is a wallet, which is to say that it's a tool, a software or a hardware module that enables a user to manage public and private keys. That's really what it is. Now, I think that the term digital wallet has been used in the payments industry, or rather the payments wrapper industry, to be more accurate, as a tool that enables someone to access an account. So if you think about digital wallets, the way that PayPal is implemented, it's basically just a wrapper around a PayPal account. And an Alipay wallet is different. It's integrated, but it's just a wrapper around an Alipay account. This is not what I mean by non-custodial wallet, and that's why I favor that term. I'm talking about actually holding these objects, these assets directly. Now, that doesn't necessarily mean that they only exist inside my smartphone-like device. I can certainly copy them and put them on a cloud hosting server somewhere, or put them in a safe deposit box somewhere as well. I mean, this is all possible, and in fact, I can even create keys and make a copy of them, and then go take my device with me. And if I drop it in the river, then I can go recover my keys from where I copied it. I mean, all of this is possible. But the point of a non-custodial wallet is to make sure that this asset is something in my possession and is not under the possession of some gatekeeper who can stop me from transacting it, or who could associate my identity with what I do with it. And that's absolutely essential.
Thank you very much. And I think that's also very clear. This allows me -1 minute to wrap up, but I'll try my best anyway. So we thank you all four of you for your excellent presentations. I think Peerapong indeed gave a whole system design possibilities, going through the various users, wholesale, retail, domestic, cross-border, offline, online. Then Julio took us through the very specific core of the business application at the wholesale level. Jonathan really spoke about the issuance and sort of the creation of central bank digital currency as digital bearer instruments. And then Geoffrey focused on the interface as to what it is that the user of this digital currency actually holds, and that the interface and the currency should be in the user's control and should not be on some account with a bank or another intermediary. I think these are the four elements, are the four fundamental questions of a basic architecture of a central bank digital currency. I don't think we have all the answers yet as to how it should be done, but we certainly have, with your contributions, a number of suggestions as to how this may be resolved. And as central banks all over the world are moving forward with their central bank digital currency projects, we will see these elements being replicated and deepened out left, right, and center, until we will actually see the central banks putting a central bank digital currency in live use for the users in the years to come. So thank you very, very much for your presentations, and I will yield back to the organizers with this. Thank you.